Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, coming to you from the greater Palm Springs area and Coachella Valley. Having kind of a cooling trend this week. We're about, I don't know, 10 degrees under normal. Last week we were well into the one teens, but now we've got a little bit of a cool off, not quite sweater weather, but still in the low hundreds rather than those 112s, 113s, 115s that were just a week or so ago. And Jeff will be disappointed if I don't give you a sports update. Just finished the Major League Baseball All-Star break. National League One on an unusual swing off. First time they've done that, I think, in the history of the All-Star game. The game ended in a tie, 6-6. So then they had a home run swing off, and of course, the home run hitter in the National League, Kyle Schwarber, helped the Nationals win the game with 3 home runs during the swing off. Hopeful for this next half. We got 66 games left in the season. I'm hoping my Angels might come around. They keep wallowing right there in third, fourth place. They're only 4 games out of the wild card. So with 66 games left, let's hope they can sprint to at least getting into the playoffs through the wild card slot. And who knows? 2002, that's how they got into the playoffs, and they ended up winning the series. So one can only hope, or at least I can only hope. And of course, you might have saw the Wimbledon final last Sunday. It was kind of a yawner. Was expecting a better match, but Sinner won in 4 sets. So not quite as good as the French Open, but he is the #1 player in the world, so not a surprise. So let's go ahead and get into the mortgage and bond market today. First, we're going to show you our rates on our website. The rates, again, I keep saying it, it's like same old news. I mean, yeah, we had a little bit of an uptick in this week, which I'll talk about in a minute, uptick in bond rates. But right now we're still right where we've been for pretty much months and months. Mid 6s for conforming loans. FHA did go back to the 6% level from 5 7/8, so a little bit of an uptick. Conforming again, VA still at 6%. Jumbos right around 6.5, and of course 15-year fix. That's a good option for some folks. Still pretty good at 5 3/4. So this notion that we're at a 7% market just isn't the case, at least not with us. So if you're thinking you're going to get a 7% loan, check with me. I have a feeling I might be able to help you on that. Let's look at the bond chart, the 10-year bond yield chart. There it is. Not quite the kind of trend we want to see. This is a 5-day chart, goes from last Friday to today, and you can see how that was a gradual increase, in particular yesterday and going into Wednesday, or actually Tuesday going into Wednesday. So that, of course, isn't that Wednesday dip Jeff likes to see. That kind of underscores when we say that Wednesday is a hump day. Certainly true this week, and that hump continues to persist. Got a little bit better this morning, so we're off the highs of Wednesday, but not by much. But look, 445 on yield is still pretty good, all things considered. So I would look at this as a positive thing, that rates continue to be pretty stable, and I think that's a good thing for the markets and to help both sellers and buyers get into the game and either sell their home, or buyers, those of you who've been waiting, I think it's time to get back in there and try to find a home to buy. So what went on this week in terms of economic data points? Well, this week was what I call inflation week, and that's because both the CPI and the PPI numbers were released for the month of June. We didn't have a Fed meeting right now. That was last week, but we do have the CPI and PPI. And again, CPI is the consumer price index. And interestingly, that was forecast, that came in at 0.3% in June as forecast. So it didn't come in higher than forecast. It came in right at forecast. And then when you look at the year-over-year number, that's annual inflation, 2.7%. And that was right on forecast. So again, these numbers came in as expected, and yet there was a little bit of reaction from the markets, from the bond market, perceiving this as a slight uptick in inflation at a retail level. In my opinion, not enough to cause any concern, but yet the market did react a little bit to these numbers. Again, it's always a reminder of that quote we have at the bottom of the page about financial markets, where they respond with reptilian minds to stimuli. So the CPI was the stimuli this week, and it did push those bond yields up just a little bit. But then we had the producer price index that came out yesterday, And that was actually very good news. It was flat in June, no increase. Again, that's the monthly number, zero increase in June from May. A 0.2% increase was forecast. So producer price index flat in June, the monthly number is pretty darn good. And again, that's wholesale. Oh, I'm sorry, that's inflation at a wholesale level, which of course, if you want to look at inflation coming down the line, you're going to see it first on the wholesale side, right before it trickles through to the retail side. So the wholesale side of inflation, in terms of the numbers, look pretty darn good. And then again, year over year, that number, that's the annual PPI, producer price index, only 2.3 was forecast to be 2.7. So the wholesale inflation numbers in particular were pretty darn good. But the damage, to the extent there was damage, was already done by the CPI. We haven't seen much improvement with the PPI release yesterday. But overall, I think this is continued indication that inflation is a lot closer to the target than we've ever been. And again, why there's so many suggestions that the Fed, Chairman Powell, needs to start doing some reductions in the Fed funds rate. There is still forecast 2 reductions to occur this year, but obviously we're getting to the point where those are going to be backloaded on the calendar. July is off the table. Now the next month, where there's an expectation of the Fed funds rate going down by 0.25%, now they're looking at September as a possibility. So we'll see how the futures market for the probability of that happening, how that plays out over the next 30 days or so. Today was U.S. retail sales. That's a very good indicator of the economy overall, because after all, retail is about 2/3 of our economy in terms of business activity. It was forecast to be up 0.2%. Well, that number came in a lot better, 3 times better, 0.6%. And that was after a dismal -9% in May. Of course, the -9% in May brought up the, we're going to be heading to a recession because of tariffs. Well, if the June number is any indication, that ain't happening, folks, because 0.6 is a pretty strong increase. Consumers are back spending at a retail level in a very strong way. So again, that underscores the fact that the economy seems to be pretty resilient, pretty strong, not seeing a lot of signs of inflation. The labor market continues to look like it's in pretty good shape. So all the doom and gloom and fears about the tariff policy just hasn't played out in the numbers, at least not yet. And then the final numbers that we're going to have for this week, they come out tomorrow, is not economic data per se, but it's all about the housing market. We've got housing starts and building permits on Friday. On housing starts, forecast is 1.3 million, up slightly from 1.26 million in May. And then for building permits, 1.39 million forecast, which would be flat from May, which was at the same number. Now, those numbers, housing starts and building permits, usually don't move the bond market too much. So I wouldn't expect much change in bond yields for the balance of the week. But, you never know. So with that, I want to go ahead and show you a special announcement before we bring Jeff in for our discussion topic for today.
We'll get right back to today's program. But first, I want to share something that could be incredibly valuable for senior homeowners. If you're over 65, own your home outright, or have at least 50% equity, you might be sitting on a powerful retirement tool, a reverse mortgage. But how do you know if it's the right move for you? That's where our free Senior Homeowner's Guide to Financial Freedom comes in. In just a few quick questions, you'll find out if a reverse mortgage could help you unlock the equity in your home to boost your retirement income. Click the link in the description to take the free assessment today. It's fast, easy, and could be the first step to a more secure retirement. Now, let's get back to the show.
Well, welcome back, and we're going to have Jeff come on, and we're going to talk about our subject for today, equity lending for real estate investors. Hey, Jeff.
Hey, Art. How you doing?
Doing all right. How are you?
Good. Sounds like the baseball team was doing pretty well this week. Have you ever watched the Savannah Bananas or any of that type of thing? Have you heard of them?
Savannah Bananas? No.
It's a baseball team that actually they play to sell out crowds, and it is nothing like you would imagine in baseball. Yes, there's still 3 outs and the bases and all that kind of stuff, but they play differently. They're actually, it's just a real fun, entertaining activity. And I just happened to see it a game the other night, and it was it was so much fun to watch. And it
Huh.
was, when you said about the home run derby, it was kind of one of those things, because at the end of the regulation, the teams were tied and they had to go through this process. And it was pretty cool, because they would have, and I don't remember exactly, but it was kind of like this, like in the first round, to try to break the tie, it was just the pitcher and the catcher,
Oh,
the guy batting had to try to hit an infield home run. If he hit it out on a hit, then it didn't count. And
mm.
so what would happen is the guy would hit it out in the infield. He'd have to run out there and get it, and then throw it back to home place.
Oh, wow.
And it was just very entertaining. Well, I guess there's a series of these teams around the country, but now the Savannah Bananas, which when the guy bought it was a failing uh, baseball team in Savannah, Georgia, has turned it into almost like a Harlem Globetrotter type of thing. They're all over the place. So
I was just going to say that's interesting. I'll have to look that up. I've not heard of that before.
yeah, it's a lot of fun. In fact, we thought, oh, they're gonna come to San Diego, and we'll go to watch that. Sold out. They're sold out months in advance.
Really?
Yeah, can you imagine? So anyway, that's
I wonder if they could beat my Angels. Maybe they could.
they dress in some wild costumes, and it's a lot of fun. And during the whole time, there's almost like a barker from a circus. He's down on the field, actually calling stuff. It's pretty wild. But
Oh, okay.
anyway, sorry, I didn't mean to get us too far off track there.
That's okay.
I just wanted to ask you about this, the inflation numbers and things. It seems like it's just, there's no winning in that. No, the numbers you shared are just fantastic for our economy, and yet it's bad news. What's that? I mean, they're predicting it's bad news when it comes in flat. If it comes in a little bit, it's coming in hot, and if it comes down below, it's wild.
Well, exactly, and I don't know if I want to suggest that. Well, maybe there's some bias going on in terms of how media reports some of these things, but yet, when you look at it at the Federal Reserve level, and Chairman Jerome Powell, again, in the most recent meeting they had, he pretty much declared that, yeah, they are seeing an opening coming to lower Fed funds rate. But he goes on to suggest that we're holding off because of an expectation that these pretty good inflation numbers are not going to persist, that they're anticipating that they're going to go up. And I just find that, I think I commented last week on the program, I find that a little odd. And I think that's why he's under fire from some corners. Is the Fed's job really to anticipate future changes in some of these economic data points? Well, to some degree, I would say that's true, but it looks like they're overly biased toward, let's ignore the current good news because we're fearful that good news is going to turn into bad. So we're just going to pause and do nothing and see if our prediction comes true. And of course, that's where the Fed sometimes gets criticized for being too late, because they're holding off, expecting these numbers to suddenly reverse and get bad. But in the meantime, there's a growing sentiment, a growing argument that not doing anything when the economy is doing what appears to be very well, not doing anything in terms of lowering rates, is going to be damaging to the economy. And the Fed needs to catch up and get with the program and consider current data. Pretty strong economy, labor market's looking pretty good, inflation's looking pretty under control. Therefore, where's the rate cut? And I don't know. All we can do now is look to September, and maybe they'll come around. Again, that could change if somehow the August numbers suddenly do reverse and get a lot worse. I don't see that. So we're in a waiting game, and unfortunately, I think in the short run, it's not helpful. Now, the good news is the bond markets, mortgage rates have remained relatively stable throughout this waiting period. So I think, again, that's good. That's a good sign that hopefully things will stay stable and hopefully maybe trend down a little bit. Remember, the Fannie Mae says we're still going to be at 6.1 at the end of the year. So I don't think anybody should get their hopes up too much, even if we do have two Fed funds rate reductions of a quarter each between now and December. Mortgage rates, aren't going to suddenly be at 5%. That's a ways off.
Well, I'm curious, and you're the economist. I mean, you've had that. What do you say, Econ 101, or you have that? And so I'm curious, if we look at wholesale prices and we see inflation actually down, doesn't that trickle down to retail prices at some point? And how far in advance are these numbers? Like when it says, okay, they're down to this, how soon before we feel it on the consumer side?
Well, that's the point I tried to make earlier, is that, yeah, obviously, if you think about it, wholesale, retail, what comes first? Wholesale. So it's the wholesale component where they're initially going to see the inflation impact from such things as tariffs. And then, of course, those businesses, those manufacturers, those companies who are then, you know, selling a product or service, and they're dealing with this wholesale inflation level, and then that turns into their pricing decisions on a retail level. Well, yeah, obviously, I mean, just common sense logic suggests that, well, if wholesale inflation is good and dropping, then it obviously follows that retail inflation numbers should trickle through and show a similar trend.
Yeah.
Now, yeah, there is a gap. You know, there's a bit of a pause between when that company, that business is encountering the inflation level at a wholesale level and then pricing their product or service to the consumer. There is a period of time there. It's probably, I would say, I don't know exactly, but I would say at least a month or two. You know, it's inflation's a backward, you know, it's a historical number anyway. It's not looking forward. So, you know, figure, yeah, within a month or two, that good wholesale number should trickle through to a good retail number. Again, we just have to wait, see if that happens. And that's what's frustrating with the Fed. It's like, well, if you're seeing wholesale inflation getting better and getting closer to the target, even closer than retail, then gosh, why would you expect retail suddenly going to go crazy and jump up because you're afraid the tariffs are eventually going to have an impact? It's really, I think, you know, I'm not in the Fed, but I think it's kind of a strange argument.
Yeah, it feels like they're just, as you said, they're just waiting to hope to find something to support their feeling of waiting,
Right.
of there could be a problem. But yet here we are, we're in August, or excuse me, we're in July, and we haven't seen anything except those numbers improve, and we haven't seen tariffs do anything except add money to the U.S. coffers. I don't see it. I guess that's the part that frustrates me as a consumer. And listening to you, I'm like, geez, I don't want to overemphasize how much you've been right, but you have been right almost every step of the way.
Yeah, and I share your frustration. And of course, then you go back and look historically. I mean, gosh, can you believe it? It's been 10 months ago. You go back 10 months ago, September of 24. If we went back and looked at the numbers, all the numbers, you know, CPI, PPI, PCE, Personal Consumption Expenditure Index, you know, the Fed's favorite inflation target, the unemployment rate, job creation. If you go back to September 24, none of those numbers were any better than what we have now. And yet the Fed lowered the Fed funds rate 0.5%. So, like, what were they thinking then? And what's changed now? Well, the only thing that's changed now is that guy in the White House who threw out this well, I said it, Trump, that guy threw out this tariff policy, and it spooked the markets. And we still are having residual effects of that, while the data as it trickles out simply are not supporting the doomsday predictions that were called out and are still somewhat being called out as, hold on, folks, it's eventually going to happen. We still haven't seen it.
No, we haven't. Well, we could beat on this horse until it's glue for us to play with. But let's move on to today's topic. I'm excited to talk to you about this. And this we're talking about that issue for real estate. We're talking about real estate investors as a business. And, you know, one of the things it says that I have here as an example, it says, hey, you built this wealth. You have rental property and it has equity because just like everybody else's real estate, it has grown in value. And so you have some equity. But the challenge is, how the heck do I get that money out of there? And that's always seems like it's a challenge for real estate investors.
It is. It definitely can be, and in part because of the profile of that person, that owner of the residential real estate, rental real estate, that borrower. They oftentimes, I can almost say maybe a majority of times, will tend to have more challenges associated with qualifying for the financing that they would need to pull that cash equity out.
Mm.
The real estate investor, and again, I'm talking about borrowers who, they don't just happen to have, although this kind of borrower is included too, but you have those who maybe inherited a rental property or a property that they turned into a rental, but otherwise they wouldn't consider themselves, real estate investors per se. But then you have this other group of folks who are really real estate investors proper, meaning that's what they do. In fact,
that's their business, right?
That could event, yeah, it's basically their business. And I over the years I've encountered, in fact, I can remember, 30 years ago, I had a customer for a while and he was a very interesting guy. I mean, he owned a paint, he was self-employed, a painting contractor, like commercial, for like painting restaurants and office, all that kind of stuff. Very successful business, paid himself a nice, handsome $500,000 a year W-2 salary, but he became a very focused real estate investor. And when I first encountered him, he owned 27 single-family houses.
Wow.
And he had a very specific strategy. He would only buy rental property with at least 20% down. I think actually it's 25% down, only with 15-year financing, because his goal was, and this is a guy who was in his late 30s.
Wow.
His goal was by the time he was 50, he was going to retire and live just off his real estate portfolio. So you occasionally run across a client like that who is a pure real estate investor. He happens to be self-employed, making a good living. That did help him with the challenges of being a real estate investor and accessing capital loans for the properties. But a lot of real estate investors aren't quite like him, and they may be a real estate investor without maybe another job or being self-employed, owning a company. So all their income's coming from that real estate portfolio. That presents some challenges because of the qualifying criteria for conforming loans. I'm talking Fannie Mae, Freddie Mac, versus what are the other options that you can access that cash if you're not going to meet the qualifying criteria in terms of, calculating or confirming or documenting your monthly stable income and then calculating a debt ratio. That's where you run into trouble when you're a real estate investor.
I think that probably solves that first question here. Share the typical challenge a real estate investor faces when accessing the equity from their rental properties. And is there more to that, or is that really the first hurdle that they typically challenged with?
That's the first hurdle, because here's what happens. If I get an inquiry from somebody who's a real estate investor, or maybe they do have a job, but they have multiple real estate, residential rental real estate. They may have 3, 4, 5, a half a dozen homes that they have rented out. If you want to get the best rate as a real estate investor on a loan, whether you're going to do a cash out refi because you need to do some improvements to that rental property, or maybe you have a first mortgage at 3% that you got in 2021, you don't want to touch that, but you need to pull out 150,000, and so you're going to look at a second mortgage, whether it's a HELoan or HELOC. Well, the first step that we're going to take is, can they qualify for what I call conforming terms? Because that's where you're going to get the best rate, either Fannie, Freddie, traditional vanilla 30-year mortgage, or a traditional HELOC or HELoan. Well, we've got to document your income. We've got to calculate your debt ratio after we determine what your other recurring monthly liabilities are. Well, if you're a real estate investor proper, you don't have any other sources of income except your real estate portfolio. That's challenging because we have to dive into your tax returns, and we've got to go through that. There's a whole process. We have worksheets that we use where we have to go through and read your tax returns and plug in a lot of numbers to come up with a resulting monthly income for qualifying. That can be hit and miss. There are times when that process, and I guess what, folks, a fair amount of people in the mortgage industry, I'm sad to say, who do what I do, aren't even very good at reading those tax returns and being able to calculate that number. I'll brag a little bit. I've gotten pretty good at that. I know the worksheets very well. I can do the math. But that's always the first step, to try to figure out, can we get them the best terms possible if they can qualify based on those ATR, ability to repay rules, that were established by the CFPB back in 2010. So it always starts with looking at the tax return. And then once we do that, if that's not going to work, then we have to look at other options.
think that's important because somebody who's bought a few real estate pieces of property in their day and had them as rental properties. It was always one of those things that the difference between at the time that I was doing this of 8% and 10% on a rental property made all the difference of whether it was going to cash flow or not. So
Exactly right.
it was really vital.
Yeah, exactly right. And so that's why, again, whenever I get somebody who is looking for, and in fact, I just had this come up last week. I had somebody referred to me, owns a rental property here in my local market, had a very small mortgage on it, and they said, we need 150 grand. We're going to kick the tenant out. We're going to do a whole bunch of renovation. It had a lot of equity. But, we're going to be looking at what their options are. And so what I always start with is, even before I determine qualifying, first thing I want to do is give them an idea of what kind of terms are available.
Mm.
Because, when you hear about the media saying that mortgages are at 7%, well, anybody who's a real estate investor owns a lot of rental property, they're cognizant of what the market is. And if they're hearing of somebody buying their first home is going to be at 7%, they already know, well, if it's a rental property, it's going to be a higher rate. So that's why we always try to look at, can you get a conforming loan first? And if not, then we look at other alternatives. So with this case, I sent them a worksheet for a cash out refinance where they refinance their first and get the cash out. And versus I sent them a worksheet for a HELOC.
Mm.
And the HELOC had a higher rate. The cash out refi had a lower rate. So my point to them was, look, you're getting you want a big HELOC is what you asked me for. Well, you have a very small first mortgage. In this case, it was like 40 grand.
Mm.
And they wanted to protect it because it was a 3.9 rate. Well, I was like, well, wait a minute. If you're going to get a second at 150 and it's a HELOC where the rate's going to be 9 or 10 or 11%, and you're trying to protect 40 grand at 3.9, do the math. That doesn't work. So that's the approach we take to decide, is it really the case that the HELOC is your best bet, or should you just get a new first and give up that low rate? In some cases, that makes the most sense. So what I start with is give them both options so they can see the numbers first, and the next step will determine, can they actually qualify for those numbers? Otherwise, we redirect and look at other options.
Well, I think that's a clear picture of the difference between, let's say, someone like MortgageWorks and Art Alvarez, and someone who, I had a banker in the Midwest that knew me from the volume that I did, but the bottom line was it wasn't Art Alvarez who said, hey, conditions are changing. We want to make sure you're still qualifying. I see here it's like, DSCR and non-QM loans, maybe for those people who are not aware of that, which I think probably most of the people, if they're watching and they're real estate investors, are probably aware of that, but share that with us, and who runs into trouble under those conventional guidelines.
Exactly. So again, what happens is we'll start with looking if they can qualify for a conforming loan. That always means looking and analyzing tax returns. When that isn't going to work, and the reason it doesn't work is after we do all the math, we can learn sometimes that if this borrower has a portfolio that might be 4 or 5, 6 homes, and based on how those homes are being reported on what's called a Schedule E to their tax return, that's a schedule that lists their rental property, where they show their gross revenue from rents, they itemize their expenses, which does include depreciation, and then come up with a bottom line after deducting their existing mortgage expense, principal, interest, taxes, insurance, and HOA dues if applicable. So we'll start there. And if that resulting monthly number is too low, which sometimes it is, in fact, fairly often it does, what's the other options? Well, that's where we get into alternative documentation. Now, this gets into the broad umbrella of what's called non-QM, non-qualified mortgage. That's a fancy label to suggest it's a type of mortgage that's going to rely on different types of documentation for qualifying. We're not going to look at your tax returns. In a lot of cases with DSCR, we don't even know what your employment is if you are employed. We leave your employment blank on your application. We don't verify your employment income. We don't collect W-2s or tax returns or pay stubs. Instead, with the DSCR, that's debt service coverage ratio, you're qualified solely on the relationship between the housing expense for the loan amount you desire. Housing expense is principal, interest, taxes, insurance. and compare that to what the monthly rent is for the property or what it's projected to be if it's vacant, and we're getting that market rent number from the appraiser. If the housing expense matches the rental income monthly, that means the DSCR ratio is 1.0. It's break even. And if that's the case, you are approved solely based on that relationship, housing expense, monthly rent, and then your rate is determined accordingly. And what's interesting is the rates on these DSCR loans are not terribly high. I priced one out this morning where you can get a cash out refinance of a first mortgage on a rental property where you're going to pay off your existing first if you have one and then get your cash proceeds. Well, if your loan to value is 60% and you got a good credit score, you can get an interest rate at like 6.75% with no points. That's pretty darn good. Now, the other option, and this kind of falls into the category of both a real estate investor who might also be a self-employed business owner. Those two combined can definitely be a recipe for not being able to qualify on a conforming loan because maybe the net rental income on the real estate portfolio is not strong enough, or the net income from the business isn't high enough because the owner of the business has done a good job of declaring a lot of expenses against their gross revenue to have a low bottom line net income to avoid income tax. Well, so if you take, the combination of those two profiles, rental income owner, self-employed business owner, they can really have a hard time qualifying. Non-QM is the option for that borrower. And if it's not DSCR, then what we use is bank statements, business bank statements, either 12 months or 24 months. From that, we can determine a average qualifying monthly income from the deposit activity, transactional deposit activity into the business, take an expense ratio, and then come up with a monthly number. That is very often a good way to get that self-employed and or real estate investor, rental property owner to get the financing without having to look at the tax returns at all. It's simply the bank statement. So those are the two primary ways a rental property owner can get access to cash equity without going through the formal conforming process of using your tax returns and pay stubs and your employment history.
Art, I had a question because I know there are people I know that are investors that will do this. They tend to try to find properties that are distressed, and then they'll buy it for a certain percentage of value on the dollar, and then they'll go in and rehab it. And they'll do this all with cash, and then they're looking to put like a 70 to 75% loan to value on the property. Is that a challenging thing to do now when you look and you're saying, well, I actually own this property free and clear, and I just want to put a first mortgage on it? Is that the best way to go, or is there another option?
Well, there's a couple ways. You can put all your cash in and, get the property and do your renovations on it. Of course, yeah, you're free and clear at that point because you used all your own cash. So obviously one option is to go back and refinance that property to pull some of your cash back out. That's definitely an option. But again, you have to, if you're going to go that way, you're going to run into the same issues we just talked about. First, can you qualify for a conforming loan to get that cash out? That's where you're going to get the best rate. If not, then we fall back to the what we call alternative doc or low doc options, which is the debt service coverage ratio, DSCR, or the bank statement programs, which, by the way, I want to point out when I talk about the bank statement programs, where we're using bank statements 12 months or 24 months to determine qualifying monthly income, that can be used if you're getting a HELOC, and that can include getting a HELOC on a rental property. You can use bank statements as your qualifying income if your tax returns don't work. So you want to keep that in mind as well. So that would be the scenario. You buy it all cash, do your renovations, then you're trying to do a refi to pull some of your cash back out. Look at a conforming first mortgage refi. You can get a conforming first mortgage HELOC. That doesn't work because of qualifying. We look at the DSCR or the bank statements. However, a whole nother option is instead, when you're looking to first buy that fixer, is there's a particular product type called a fix and flip where you can buy the property, get financing to buy it, and that financing can include some of the cost to do the renovation. And then the idea, of course, in that scenario, and the reason I call it fix and flip, is that once you've got the renovations done, your intent really as the owner, as the investor, you're not really looking to keep it as a rental property long term. Instead, you're looking to flip it for a profit. So there is that specialized product, which is another way to, again, acquire that fixture, finance the purchase with a loan, as well as some of the improvements. And then once you're done, obviously your intent, your goal, not always works out. Your goal is to be able to then sell it at a higher price and cash in on that profit. So that's a whole different way you can achieve that same result.
Art, back in the day when I was doing this, we would sometimes do that using hard money lenders.
Mm-hmm.
And those rates were pretty high. Back then we were paying 15% and we were paying some pretty outrageous points. Is this a better thing now with the fix and flip loan that you just described? Is it a much better option?
Yeah, I would say it's a relatively better option. I mean, some of the fix and flip programs are essentially private money. Although I'd want to make a quick distinction there. There's private money. That's a kind of a broad label.
Mm.
I mean, private money can include, just private individuals who have a lot of cash and they're in the business of, funding those types of transactions as an individual. So it really is a private person who will make those kind of loans. And there are some out there like that. I actually work with a local here in our market, the Coachella Valley, a local private money lender.
Mm.
And he has a subprime alternative lending, institutional lending background, but now he's a private money lender, and he has a whole network of private investors who are literally, in a lot of cases, mom and pop type people. Wealthy people who have some extra money that they want to invest, and they like investing in real estate, and that's where he gets his sources of capital to make these loans. So that's one kind of private money profile. The other is there are institutional private money lenders out there, big companies who that's what they do, and we kind of put them in the private money category because they're not using any kind of financing that's going to end up with any of the federal agencies like Fannie, Freddie, FHA, VA, and so forth. So that is a whole nother private money type of a company. And those are the ones that tend to do these fix and flip type loans. I've got a multitude of wholesale lenders that I get emails and calls all the time, promoting their fix and flip and all their non-QM product. So there's a lot of them out there, and that fix and flip type product, the pricing's gotten a lot better than the old days, like you probably dealt with, 15% and 4 points.
Yeah.
It's not anywhere near that bad. It's still going to be a premium over a primary, residence home loan. It's not going to be 6.5. It may be 8.5, but the point is, it's a more common and accepted product type. Has been used quite a bit over the years. Although in the last year or so, activity in that particular arena has diminished somewhat. But the financing numbers really aren't that bad. In fact, that's one of the things about real estate investors in general, is they are a little bit more savvy to the fact that the type of financing they're getting is considered business purpose financing, essentially almost like a commercial loan, even though it's being made on residential property. And so they're a little bit less, I guess, impacted when they hear that the rate's going to be 7 3/4. I might be dealing with a homeowner who's got a 2.5% mortgage on their primary home, and they decide they want to buy a rental property. I can help them pull cash out of their current home to do that. But then if they want me to finance the purchase of the rental property with a loan, then they find out the rate might be 7 1/4. It's like, oh my gosh, that's so high. But a savvy, experienced real estate investor is like, that's not bad.
Mm.
Plus the fact, if it's a DSCR loan and my rental income, even at that rate, I'm going to break even for the loan amount I desire. That's fine. I'm a business person. I mean, as long as I got positive or break even cash flow, I'm going to get the financing I need and be able to do the renovations that I need to do. So essentially my tenant's paying for the cost of this financing. So I'm okay. So it takes that kind of mentality to understand that these non-QM options, though they may seem like they're very high rate, are really pretty reasonable when you consider the trade-off that's being provided to that buyer. Again, consider on a DSCR loan, you don't you don't disclose employment. You don't disclose employment income. It's all blank on your application. Your other monthly debts for car payments, credit cards, not considered. So you could have, $80,000 of credit card debt and $3,000 a month car loans. Well, if the DSCR number works out okay, you can get that loan in many cases, even though otherwise you wouldn't be close to qualifying for a conforming loan on that kind of rental property.
It sounds like, Art, with your expertise and really an understanding of the local market, if I were a real estate investor investing in the Coachella Valley and I wanted to do investing using financing, I'd want to get a hold of you because you kind of have your thumb on the pulse of what's happening. Is that fair to say?
I would say so. Again, I know the market very well. We've been operating out here in the Coachella Valley since 1999.
Wow.
So yeah, of course, after that many years, I know the neighborhood fairly well, and of course, combine that with I'm a ancient old man in the mortgage origination business, 44 years in it. So you put all that together, and I've just what it helps me do is it's rare anymore for me to come across a situation, a scenario that I haven't encountered before, and so I can fall back on just my experience in the past and draw on that when needed to kind of help be a sounding board for a real estate investor and try to be able to give them what ultimately and long term is going to be the best financing option to accomplish what they're trying to achieve.
Well, something that I think is that I've taken away from this conversation is you understand that the investor is not like a homeowner. This is their business, and as an example, at one point I had 10 rental properties that we'd paid cash for, and we'd push the equity up or the value of the home, and we were just going to put loans on them. Well, in the point of purchasing them, rehabbing them, and then going to get loans, the whole structure of the market changed, and we were stuck. We couldn't get our money out of those. So it's really enlightening to hear that, hey, you have a way to help these people, that because let's face it, we're taking that money, fixing this property up, taking out the extra, and then going buying another one. That's how we do business. It's almost like saying, I'm selling this bread, and the profit on the bread, I'm going to make more bread. And
Right.
So it's really nice to hear that. So any last thoughts before we wrap this up? Because this is not a conversation that normally you talk about. It's normally for the consumer and buying their own home and living in it. But this is a different mindset for real estate investors.
It is a different mindset. In fact, one of the other aspects of this type of financing for real estate investors that doesn't really scare them off like it would, the mom and pop, they own their primary and maybe they want to dabble in, rental real estate, but they've not had any experience before. The DSCR product in particular, again, debt service coverage ratio, just think housing expense matches rental income, you're approved. That's at the simplest terms out how it works. Well, that type of loan, a primary feature of it, I'll call it a feature, is they come with prepayment penalties. And for a DSCR loan, you're going to get the best rate if you're willing to accept a 5-year prepayment penalty. Now that would scare most consumers to hear that. Real estate investors, not so much. Again, they understand this is their business. They're in it for the long haul. To own this residential rental real estate, and eventually, if they're not already living off the income stream, they intend to when they retire and so forth. So they have a longer term, horizon in terms of how they look at this stuff. And of course, what we should do is we show them that you have a choice. You can get a DSCR loan with no prepayment penalty, but the rate is probably going to be a half, maybe as much as 3/4 higher than if you take a 5-year prepayment penalty. A good real estate investor, a business-minded real estate investor, will look at that. We'll show them all the options, and then usually they'll pick somewhere in the middle. In fact, I've found lately when I do these, the sweet spot seems to be about a 2 to 3 year prepayment penalty, where you can get a pretty darn good rate and not feel like you're stuck for too terribly long with that loan. So that's one thing I would suggest is that the mom and pop consumer who's not experienced with residential real estate, rental real estate, gets a little scared of. And I would urge them not to think that way, because one of the things about the DSCR program I like so much is it's an avenue for somebody who doesn't own rental real estate yet. Maybe they came across some cash that they have where they'd like to go ahead and buy their first rental property. And maybe they've talked to somebody like us, like me, and I say, you know what, it's not gonna quite work based on your employment income and so forth, but here's another way you can get into the game. Here's this DSCR product. Once I explain to them how that works, it's amazing how many folks go, yeah, I like that. I can tolerate a 2 or 3 year prepayment penalty period. And if this is my pathway to get my first rental property under my belt, let's do it. So I've gone through that several times with newbies to rental real estate, and it can work very well.
Love it. Well, I put your information on the screen there, 760-969-5023. That's Art's office, and also his cell phone number on there, 714-612-9035. If you are a real estate investor, or as he says, a wannabe newbie, and figure out, hey, how do we get started? I think it's wise to give him a call, because, as it says here, they have the answers and they're on the house. Art, thank you so much for taking the time to talk about this today. I appreciate it.
Okay, thanks, Jeff. Well, thank you everyone for watching and listening to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Have a good weekend. Look forward to seeing you next week on our next edition of the Mortgage Minute. So long. Take care.